welcome everyone. Thanks for coming along today to our webinar on financial planning in local government. So we're really focusing on the next year, 24-25, and then over the medium term as well. In terms of the agenda today, we'll start off with looking at our MTFP model, medium term financial planning, and what the assumptions are that we've got in that model. Then Dan will do a session on the latest data that he's got from the 22-23 accounts, looking at capital health, gearing ratios, and all that kind of thing. So some really interesting, right up to date information about what's happening in local government and local government financial health. And then finally, I'll come back and we'll talk about the extended producer responsibility. I can't promise to be able to offer you anything firm about that, but at least we'll talk through what we do know about what the proposals look like and what the options might be for in terms of how that affects local government funding. We are recording the webinar and it will be on our website. I've said tomorrow, but actually I think it'll be Monday morning, if that's okay. So you'll be able to look at that and share that with colleagues if you need to. I'll put the slides onto the website straight away after the session's finished, so they'll be available for you. And as normal, the first hour, 10 to 11 will be our presentations, and then from 11 to 11:30 there's chance for discussion and Q&A and debate and that kind of thing. So feel free to stay around for that as well. So starting off with the overview of the first part of the presentations today, looking at the MTFP model, and really the first bit will be looking at the major MTFP assumptions that we've got in the latest version of our model. And that latest version 5.9 is on the website now. I put a draft version up at the back end of last week and a revised one on Wednesday. Thanks to everyone who looked at the model and came back to me with challenges and queries and questions about it. It really helps to improve the model and make sure we've got accuracy in that model if people do come back. So it's really, really helpful. Thank you. The polls, I'm going to try and do 4 polls, as I said. So the questions will be around: are you assuming a business rate multiplier freeze? What are you assuming for CPI in 24-25? What's your assumption for SFA growth from 25-26 onwards? And when do you think local government reforms will go ahead? So we'll put those up as we go through the presentation today and try and get a view about what you've got locally in your own plans, because I think that's always really helpful. You know, when you are doing your financial plan, you know, it's not just what we're saying in Pixel or other places, but also what are your colleagues in other parts of the sector doing? That always helps. It's always better to be part of the pack than to be an outlier. So just trying to understand what might be going on there. Then we'll look at how to use the model as well, and focus on what those main variables are in the model. And it's one of those things I want to get across today, really, which is that we can't be sure about what's going to happen in 24-25, never mind 25-26 onwards, but we can try and spot what we think the main variables are. And then I think the key thing for you and authorities is to then use the model to explore what the impact is of the range of those different variables. So what's the range in terms of the total amount of funding that you might have in the short to medium term? So it's understanding the risk and the range as much as getting the forecasts absolutely spot on. So the MTFP model, really, it's our best estimate of overall funding, both in terms of the quantum and the distribution of that funding, both in the short term for 24-25 and over the medium term from 25-26 out to 30-31. So our model works over that basis. That's our kind of forecasting horizon. I guess we could push it out even further. I know some people have asked whether that would be possible. I think in some respects that would be useful, because seeing how things do work over a longer period of time, I think it's really quite helpful for looking at financial health and sort of long-term financial sustainability. In terms of our model, it starts to make the model a little bit larger than you might like and a little bit more cumbersome to use. But I think if enough people are interested in that, that's something we could definitely explore. So as I said, there are many uncertainties, but I think the ones where you know, there are the biggest range, and they're the things that I think we should focus on. They're things like the consumer price index for 24-25. That now is a real world figure that does affect not just the multiplier, but it affects settlement funding assessment based on funding level and RSG as well. So it's a really important figure, at least for 24-25, if not for the longer term. And then the big changes around things like SFA, social care grants, assumptions for Band D from 25-26 onwards. In the short term as well, we've got these technical changes around the 23 revaluation technical adjustment. We'll look at that in some detail, but you've had the draft version for 23. There'll be a revised version for 24. So working out what that is, and the model does that now for you, is important. And then finally, probably the biggest variable of all for many of you will be these local government funding reforms. You know, what they are, what they mean, and absolutely crucially, when they will happen. We just don't know that. And for those of you who are expecting to lose from things like the baseline reset or lose from the fair funding review or alternative to gain substantially, that not happening has a big impact on your funding and your forecasting. And I know in terms of credibility with members, to constantly be saying, you know, oh yeah, the reforms are going to happen the year after next, so we need to prepare for them, and then to say actually it's the year after and keep pushing it back. I know from what you've been telling me that's really quite tricky. And then of course there are a range of local inputs that you can put in, so you can update those. There aren't that many of them, but for business rate income, your latest outturns and forecasts, your Band D assumptions, where you'll be within the range up to the threshold, forecasts for tax-based growth, and if there is another year, what your NHB growth looks like as well. So they're important local inputs that you'll need to work through in the model too. So as I said, what we would recommend is using the model to understand what the drivers are for future allocations and then estimate the potential range of possible outcomes. So starting off with the 24-25 settlement, which in the context of the recent past and the medium term, we actually know quite a lot about what will happen in 24-25, thanks to the policy statement that was issued on the 12th of December last year. So the referendum principles for council tax will continue the same as set out for 23-24. So that's 2.99% for the core, 2% for the precept for social care, and then 5% maximum or higher of 2% or 2.99% or £5 for district councils and fire authorities. So we're assuming, based on what that statement has told us, that those thresholds will remain exactly the same. Then it says the core settlement will increase in a similar manner for 24-25, and major grants will continue as set out in 23-24. So I guess you could say that's a little bit woolly around the edges, but I think the thrust of that is to say that the approach that was taken in 23-24 will be replicated again in 24-25. So for the social care grant allocations, the overall amounts have now been confirmed. They were announced in the 22 autumn statement. And I think we should assume as a default that there is no change in the distribution of those grants. And in our model, we've assumed that there is equalisation of the precept in the way those grants are allocated, but that's done with only £160 million of that precept actually equalised. So it's not full equalisation. So for those authorities that have got a very high tax basis, so people like Surrey County Council or Buckinghamshire or West Sussex for that matter, you know, our assumption would be that equalisation will continue on the same basis. That makes a big difference to those authorities with high tax bases. And if we look slightly ahead into 25-26, we are definitely assuming that the baseline for funding for social care are the grants that you're receiving in 24-25, and that any future increases in social care funding will be in addition to that. I really can't see them trying to repurpose those grants for anything else, even for any kind of revived social care charging reforms. I think they're yours now in your baseline for the future. Business rates pooling and 100% pilots we assume will continue into 24-25. There is the possibility we hear of new pilots for Devo deals in 24-25. I don't know how realistic they are, but they're certainly on the agenda. But they won't affect other authorities that aren't directly affected by those deals. We still await yet again a decision on New Homes Bonus. The consultation was in February 21. We're expecting a decision on NHB before the provisional settlement. We're not expecting any further consultation. We're just expecting that decision. There has been talk that New Homes bonus and extended producer responsibility will be mixed up in some kind of deal, that we don't have NHB, but we do have EPR instead. I don't know about that. I don't know how realistic that is, or whether that is something that is being talked about, but that's certainly a rumour that I've heard about. And for EPR, we'll talk later in the presentation, but we are awaiting a decision about what happens with the EPR. There's a lot of income associated with this new responsibility that will come to local government. And in the policy statement, DLUHC said that they will think about adjusting the settlement to take into account that EPR income. But again, we just don't know how that will work. So it's one to flag up as a risk, but we just don't know what it will mean. Will there be a summer consultation? It looks pretty unlikely. The recess is on the 22nd of July. We're not hearing any sort of rumours about a consultation of any sort, and I really wouldn't expect that. But you never know. And if there is anything, I think it'll be on NHB or EPR. I've just seen a question pop up in the chat about EPR. If it's okay, we'll come back to explain that in a bit more detail in the final session. It's basically a new responsibility that's placed on retailers and waste producers who create packaging, and they'll have to pay for the full cost of that packaging, and that income comes to local government, either to the sector as a whole or to individual local authorities, and that income could be substantial. It could be 780 million in 24-25, rising to £1 billion in the year after, but we'll come to that in quite a lot more detail later. So with revaluation for the 23 revaluation, you'll recall that in year one, in the current year, an initial adjustment was calculated based on this extremely complicated technical adjustment. You got an initial valuation based on the draft rating list at the end of 2022, and using the NNDR3 for 21-22. For 24-25, for year two, that will be updated. So it'll be updated for the actual final rating list as at the 1st of April 2023, and with the most recent NNDR3 for 22-23 as well. So it's basically using the same calculation, but just using the latest versions of rateable value and NNDR3 to calculate that. So in year two for next year, you'll have two elements to that adjustment. There'll be a new ongoing adjustment, and there'll be a one-off adjustment for the difference between the initial one and the updated one. So two elements to that. We've now got that calculation working in the model. So as you plug in your outturns for 22-23 for NNDR3, that will then update the revaluation calculation within the model. And we've also already plugged in the final final rateable values for each authority as well. So it should give you the revised revaluation, the new updated ongoing adjustment for 24-25, and the one-off adjustment as well. Just be aware there are some complications there around if you're an authority that's got designated areas, it does get really complicated. If you've got any concerns, please just drop me a line or give me a call, and we'll try and work through that to make sure that you're getting an adjustment that's correct. The one thing that does make a difference is, where you got some tactical scope for manoeuvre, is really around appeals and that closing balance on appeals. So the higher the provision that you put in at the year end, the larger the increase in RV that will be reflected in that adjustment, and the lower your top up and the higher your tariff. So obviously you want to keep that provision as low as possible, but clearly you need to put through a provision that the auditors are happy with and that you're happy with as well. So there's some tactical scope, but in the end, I know that you'll want to have an appeals provision that reflects reality as closely as possible. And I guess with lots of late appeals coming through on that rating list, for many of you, that appeals provision may have gone up quite a bit. So it's based on that steady state closing balance rather than the actual contribution that you put in year. For some authorities, there's been a bit of a movement between, and it's just unlucky, I think, for some authorities where you've shifted from being a top-up authority to being a tariff authority for some unitaries. And then I think in the case of North Somerset, shifted from being a top-up authority to being a tariff authority for 23-24, and then probably back to being a top-up authority again. So you go from having no levy rate to a small levy rate to back to no levy rate again. I think it's a really small handful of people. Until we see NNDR3s, we won't know exactly who they are. But for some individual authorities, that's an unfortunate and I think unfair aspect of the system. And that's one thing I think we'll try and approach DLUHC to get some kind of dispensation on that. So start to move forward to look at the consumer price index. As I said, this is now a real world factor for you in your forecasts for next year. So the business rate multiplier is linked to the September 23 CPI, which is announced in October 2023. Forecasting it's really difficult. It's widely expected by all forecasters and commentators that inflation CPI would fall quite quickly during 23, but the pace is proving very hard to forecast. So the OBR forecast that CPI would drop from 10.1% in March right down to 2.9% in December. That always looked quite bullish, really, but so it's proved that looks really unlikely now. So CPI is remaining a lot higher than expected, and particularly because core inflation continues to increase. So the latest we have is that CPI has remained at 8.7% in May, the same as it was in April. So you can see there in the chart on the right that the May figure is this sort of chart shows the range of forecasts that was in the Bank of England's CPI forecast from back in February. So that's kind of the range they had at that point. You can see the May figure is within the range of forecast possibilities the Bank of England had, but it's pretty much towards the top end of that range. For us, we're thinking that the September CPI could be around 6%. That's the back end of Q3, but I'm not quite sure. It looks like it could be a little bit higher based on the latest figures. So I think our range probably is somewhere between about 5.5% and 7.5% realistically, but that makes a big difference to the outcome of it makes a big difference to the increase in SFA primarily because SFA along with RSG and BFL will be uplifted in line with the multiplier. So in the model, we've got a default of 6%. That, as I said, we recommend that you would look at a range between 5.5% and 7.5%. Right, the first poll. Let's see if it's going to work. Okay. Can you see that? Is that popped up, Dan?
Yes.
Yeah. Okay. So I think I can see the poll numbers coming through. So I can see from this that, and I'm sure, because can everyone see the results?
Yes.
So basically, it looks like 40% of you have gone with or are going with a figure of less than 5.5%. 23% are going with 6%, which is our default figure. So I think I'm taking from that most of you are being very prudent about what this figure will be, because it does make a difference to what your funding is. 42% less than 5.5%, 21% 6%, 10% 5.5%. A few of you, 10% are going for more than 7 percentage points. It could be correct. We just don't know. Inflation is proving to be much stickier than people expected, but that's interesting. And I'll make sure that these poll results are circulated as well later on, so you'll see those results later. So that's the first part of this slide. The second part is, do you think that ministers will freeze or cap the multiplier in 24-25? It's been frozen since 2021, so it's been frozen at 49.9 pence since then. The default that we've used in the model is that it will be frozen. I know lots of other people have got different assumptions. I know when I speak to Lee at LG Futures, I think their default in their model is that the multiplier won't be frozen, that it will go up with CPI. I mean, the reason we've done this is simply because it's been frozen for so long. You know, businesses are so much under pressure, and ministers are really aware of that. I think it probably will be. I think it probably will be frozen. But what do you think about that? Let's see. So we'll launch the next poll. Do you think that, or are you assuming that the business rate multiplier will be frozen in 24-25? And what have you got in your forecasting plans? Okay, so that's a fairly strong response there. That, you know, actually it's falling back now, but it's still a fairly strong response. 83% of you are assuming in your forecasting that the multiplier will be frozen in 24-25. So it's a really interesting figure to get that. I thought it might be more balanced, but that's interesting. That's the way you're going. That's good. For most authorities, that doesn't have a material effect on your funding, but for some of you, those of you who are a long way above or a long way below your business rate baseline, it does have an impact, because if it is frozen, if the multiplier is frozen, then you'll get the cap compensation based on not just your baseline funding, but you'll also get it on anything above or below as well. So if you are a long way above or below, it's worth having a look at the model and looking at the impact that freezing or not freezing the multiplier will have on your bottom line funding. So cap compensation, if the multiplier is frozen and if CPI is 6%, there are our default assumptions, then the cap compensation fraction will increase from 85/499 to 119/499. And the cost of freezing the multiplier for local government continues to grow. We think by about, nearly £1.9 billion, from 2.2 to 3.1 billion. So it starts to become a really, I mean, it recently has been, but it becomes even more a very, very large chunk of our overall funding. It's worth about 24% of business rates income and worth about 4.7% of core spending power. So it's a really important part of our funding package now. After the baseline reset, which we're still assuming is 25-26, we assume that the funding from cap compensation is retained within the sector and is redistributed to local government pro rata to needs, i.e. based on funding levels, just to be aware of what we're thinking there after there is a baseline reset. We've made a range of different changes to the BRS tab. They're mostly in terms of the way that we present the data for business rate pilots compared to the 50% scheme. Hopefully this is useful to pilot authorities when assessing the impact of the pilot, and hopefully in terms of how you report that information locally as well. The assessments or the numbers in the tab are made on an individual authority basis. In reality, things like no detriment and the safety net are calculated for the pilot as a whole rather than individual authorities, but at least this gives you an idea of where you are individually. We're assuming that in the model that the pilots continue into 24-25, but I kind of get the feeling they're becoming a really kind of permanent part of the way that the system works. So I wouldn't be surprised if they do become a permanent or semi-permanent feature of the system even after a baseline reset. And part of that is just because some of the things that I've said in the autumn budget last year, that the government is giving a long-term commitment to authorities to retain 100% of their business rates, and then talking about, as part of devolution, expanding local retention of business rates to more areas in the next parliament, and working with interested councils to achieve this. And I know some new Devo areas, or existing Devo areas, are looking for similar sorts of pilot arrangements as well, with 100% retention. So I just wonder whether certainly this government will be minded to continue pilots for semi-permanently into the future. Of course, the thing we don't quite know about is what government will be in power in the next parliament. And that could have quite an important bearing on what happens with things like pilots and 100% retention. Just more of a note, really, we have updated the growth forecasts within the model. So if you do see some large increases that you weren't expecting in our modelling in 24-25 and beyond that, that's just because we've updated our default settings for forecasts for individual authorities. We've used the change in rateable value between April 2017 and April 2022 just to give an indication what might happen. This is more for our overall modelling of what's happening with overall business rate growth in the future, so we can kind of predict what the business rate surplus might look like in future years. Clearly for you individually, please overwrite our forecasts in the BRS tab in the yellow cells there that give more of a realistic assumption about what your figures are and what you're looking at in terms of forecasts and outturns. But just to give you an indication there what those numbers look like. And what's striking is that some authorities, based on those numbers, have had, and I guess will continue to have, very, very strong growth in business rates, particularly people like North West Leicestershire, South Cambridgeshire, Suffolk, Rugby, etc. Some really, really big increases in rateable value. Then looking more at the medium-term assumptions for within the model, and just looking back at that budget in 23 in the autumn, and just to say that we know that that the public sector finances are very, very tight. Headroom was only 6.5 billion back in the autumn, much lower than most chancellors have been playing with. So it does mean that there's not a lot of funding going around in the public sector, and that includes for local government. And a key figure that we're really looking at is what's the overall growth likely to be in local government and in unprotected services from 25-26 onwards. We know what's happening in 24-25, but we don't know what's happening in the next spending review period from 25-26 onwards. So overall, people like the Resolution Foundation are saying that spending overall will grow by 1% in real terms, but once you start stripping out things like the NHS, defence, schools, etc., there's not a lot left for everybody else. And their forecasts are that there'll be real terms cuts in unprotected services of about 1% per year. But one thing they do say is that they think that this kind of spending restraint is not really deliverable, and in the end a new government would actually look at increasing spending, probably through tax increases, rather than the kind of really severe cuts that we saw in the period from 2010 to 2017, 2018. So just bear that in mind when we look further forward. So if the starting point is a real terms 1% cut in funding for unprotected services, and just be aware it could be worse than this, that does break the link. We think it breaks the link between those sort of multiplier CPI increases and SFA increases. But I just don't think those sorts of increases for local government are affordable or likely. So what does that mean in terms of what the forecast increase is in SFA from 25-26 onwards? If we think that the starting point is 1% real terms cuts, and the GDP deflator is about 1% per year, 1.1% per year, that gives us a cash terms increase of about 0.1%. If we think that if the inflation factor the government will use will be the 2% CPI target, 2%, that gives us a cash terms increase of about 1% annually. But if we include the tax raising ability of local government, and that if the Treasury decides to take that into account as well in setting our funding allocations, and council tax delivers about 3.5% increase in CSP, then that potentially gives us a cash terms cut of possibly up to 2% per year, or even slightly more than that. So that gives us kind of a range really between minus 2% cash and plus 1% cash. It's quite a large range, and there's quite a big downside potentially. Our view is that cash flat is the most likely outcome for the sector. So that'll be cash flat for SFA plus the council tax increases on top of that. But in reality, it's that range of sort of plus 1% down to minus 2% cash. So the next poll, let's see. Just asking you, what's your assumption for SFA growth in 25-26 onwards? From +1 right the way down to -2 or even -3. I mean, if you have got a view about that, please put it in there. Just working through that. Looks like most people are going with cash flat as well. Some people, the numbers are starting to reveal themselves. Still, a definite majority, about 80% going with cash flat, about 11%, 10% going with a +1, and then everyone else going with with reductions, whether that's small percentages going with -1, -2, -3, and then 3% with others. So it's mostly 80% 0% cash flat, 10% +1, and then everyone else with smaller reductions. That's really interesting. Thank you very much for that. I do think, though, that adult social care funding will be treated differently. I do think that we're now in a position where ministers need to have growth in social care funding. Partly for the sector itself, it's becoming politically important by itself, but also because it helps support the NHS and to get those the waiting list down as much as possible. But what figure would that be? We're thinking a default of £500 million increase per year in that social care grant from 25-26 onwards. The average increase over the last 6 years or so has been about £900 million a year, ranging from 368 million to a whopping 2.4 billion in the current year. So 500 million is probably on the low side compared to the recent past, but I think that's a sort of prudent, reasonable assumption to go with. And then, of course, on top of that, the precept going up by 2% per year as well. In the chart on the right, what we've done here is we've shown you the increases in social care grant, so going up from 1.3 billion up to nearly 8 billion. Also the increase in social care precept as well, now nearly as high as 4.3 billion, but also included within that the funding that notionally goes to social care from the core Band D and from SFA. And if you put all that together, I think that funding for social care has doubled in cash terms between 2015-16 and 24-25. So we've had a really, really big increase in the amount of funding for social care in the last sort of 5, 6, 7 years, which is good compared to what we got to the kind of the nadir in funding for social care that we got to in 2015-16. But it just shows you how much additional funding has come through. Putting all those assumptions together in our MTFP model, and you can see here what we get to in terms of in terms of core spending power. So the black line shows you the annual increases in core spending power, and that we've had in recent years pretty strong increases in core spending power. You can see here that in 23-24, over 9% plus increase in core spending power, and we've been above 6% for pretty much each of the last 5 years. Certainly planned increases in the last 5 years have been above 6%. 21-22 dips down there because council tax dipped down rather than because funding was low. But going forward, we're assuming, as you can see there, from 25-26, that overall core spending power increases by about 4.5% per year. So that's cash flat for settlement funding assessment, biggish increases, about 3.5% worth in core spending power terms for council tax, and then £500 million per year for social care. So actually reasonably good increases, lower than the last 5 years, but much higher than the previous period. So you may look at that and think, well, that looks quite high, but I think that compares fairly well to the recent past in some ways. If you want to make that more pessimistic, I think what you need to do is go back into the model and actually look at cash terms reductions in SFA to bring that down a little bit. The dotted line shows you the GDP deflator, which is, as you can see, has given us quite large real terms increases in core spending power in recent years, and will continue to give us pretty good real terms increases as well in the future from 25-26 onwards. The GDP deflator is not always accurate. Inflation could be higher in the future, but it does show you that in that sense that that kind of core spending power increase of 4.5% is pretty good. But feel free to go back and look at that, make it more pessimistic, or change some of the assumptions to get a different outcome. Then the final package before I hand over to Dan is just looking at local government funding reform. We know it's been pushed back after 2024-25. The December policy statement confirmed that. The reform package itself is likely to include the fair funding review, changes in business rate retention, particularly the baseline reset, possibly tier splits, plus changes in the distribution of other grants like social care, public health, and potentially the reform of new homes bonus as well. Now, our assumption, and Stuart Hoggan earlier this month was really interesting on this, that if there's a general election in the spring or the autumn of next year, that makes it very, very difficult to implement reforms in 25-26, especially if there's a change in government. So 26-27 looks much more likely than 25-26. But we haven't changed our model yet to push our assumption for funding reform back to 26-27. And that's simply because just given pause for thought by some of the rumours swirling around that there might be an election in the autumn of 23. I think it's extremely unlikely, but it was just that slight outside chance that just made me want to pause a little bit. So just about, if there's an election in the autumn this year, that would just about make 25-26 possible. I do think it's unlikely, but we'll just hold back, and I think I'll probably change the model later in the summer if that's okay. One final point though is that the scale of change is now so great with things like the baseline reset, fair funding review, population change. There's almost a question about whether any of these reforms are actually deliverable now, or whether the scale of change is so large that ministers pull back from it. I think I've got one final poll coming up, which is which year are you assuming that the local government funding reforms will take place? 25-26, 26-27, later in the Parliament, or never? So let's see what you're assuming. So about, oh, it's moving. I need to wait for the results to come in before I try to comment on them. Here we go. So the most, yeah, just over a third of you saying 26-27. So that's got the plurality, but 25% still on 25-26. Another quarter on later in the Parliament, and 11% of you never. Okay, so I think that probably starts to suggest that quite a lot of you are still on 25-26, but we're moving towards 26-27 as the most likely. And I think, as I said, I think we will change the model later in the summer to push that back. I just put this in just as a placeholder, really. Feel free to look back at our webinar from the 7th of June, but we talked about this in quite a lot more detail. But just to be aware that in the latest version of the MTFP model, we've actually loaded in there a range of different scenarios, and we're getting to the point where there was such a lot of different scenarios with a big range of potential outcomes that it's worth, I think, looking at these different scenarios and looking at what the impact is on your authority and what that looks like, just to get an idea about what the range looks like. Similarly with the baseline reset, we've got two different methods in there. Had a few authorities asking about the different methods, but just to let you know that there are two ways of doing that baseline reset in there, which makes a small difference to authorities in terms of what that reset looks like. We're assuming that the reset, the surplus gets redistributed pro rata to needs to baseline funding level, but give me a call if you want to talk about that in any more detail. The baseline reset negatively affects district councils disproportionately, so it's a huge deal for most district councils. So again, give me a call if you want to talk about what impact that has on your numbers. And almost finally, transitional support damping. We have got a model. We have got damping included in the model. You know, it is going to be quite a big deal if these reforms are put through. Some authorities will be losing considerably, but it is very expensive to help those authorities out just because of the sheer scale of change. We think in year one, the damping could be worth about £758 million, and that would require for it to be self-funded for authorities to be scaled back by nearly 10%. So very expensive and a huge amount of disruption. If I answered that already, and I'll now hand over to Dan.
Thanks, Adrian. So I'm just going to run through the latest on the accounts. Some of you might come to a session we did a couple of weeks ago that looked at that, but since then there's been a few more accounts published, so I'll run through those if you want to move on one slide, Adrian. Starting with the numbers that are published. So this was right as of yesterday, when I think Basingstoke and Dean and Wakefield met, published their accounts, and I wonder today, I wonder if there's any of you on the chat actually that will be publishing today, because it's the last day in June, or last working day in June. That's last day in June, isn't it? and quite a few in their publication notices said they would try and get accounts in by June. So we're expecting, when we trawl a little later, to look to find 1 or 2 additional accounts. Oh, excellent. Lots to go at today. 1 published today and 1 later today. That'd be good. That was exciting. That's made my weekend. Thank you very much, everybody. So I think we'll be close to 50%, if I'm honest, by the end of June. But you can see there that 69 upper tiers, 69 districts out of 314 authorities altogether is still less than half. If you move on then, Adrian. So what I'm just going to talk through quickly is an approach that we're taking this year, following SIP4FM code, which still, I'm not sure if it's mandatory, whether many people know about it or whether it's been pushed forward, but it is actually quite a decent piece of work, although it very, very duplicative of the annual governance statement, SIP4SOLACE code. But those yellow areas there are in the FM code, but not in the SIP4SOLACE framework. And I think they're really important areas. And we'll talk a little bit about this as we go through some of the analysis. But I think there's real financial stress now in the system that's been hidden a little bit by the COVID grants over the last couple of years. And now that they're disappearing, I think there are some authorities, not all, but some authorities that are in real problems. And not just the ones that you hear in the press, but looking at some of the figures that I look at, I would imagine there are a few that will rear their head over the next couple of years unless something drastic happens, either on funding or those authorities really get to grips with their financial health. But if we move on one, so this is our approach to the balance sheet. Everything in the balance sheet, for me, splits into 3 areas. It's either part of your current account, it's your reserves and the other bits and pieces, adjustment accounts, etc. You have it's your capital account, which are the equity reserves of the capital adjustment account and reval reserves, and then all of the capital assets up at the top with the borrowing in there, with a little bit of an interplay between current and capital for internal borrowing. And then there's the pensions account, and pensions have gone a bit mad this year, as I'm sure you'll all know. So where there was massive liabilities in previous years, there's now it's a bit, they're really low, or quite a few authorities have pension assets now, so their assets outstrip their liabilities in their pension fund. But taken together, we're going to, for our members, we look a lot more at the balance sheet and what that's telling us. So just looking, if we move on one, this is from, I think this is a couple of days ago, so it's 124, not there's a few more got to input into this model. This, if all the authorities that had published today were one, then this would be their balance sheet, or elements of their balance sheet. So I suppose the headline though is usable revenue reserves have come down, and they come down quite significantly, come down by 12% across all authorities that are published. Now that hides some massive differences between types of authority, which I'll go through in a minute, and individual authorities. There are a few authorities whose rate of depletion this year is greater than the reserves they've got left. So if they deplete at the same rate last year, they'll have run out reserves. So that's not a particularly clever situation. But from looking at the balance sheet, we actually pick up some other trends that are really interesting. So school balances are down. HRA balances now under a lot of pressure and are heading downwards. And for the upper tier colleagues amongst you, you probably moved from into a dedicated schools grants deficit, and those deficits are getting bigger and bigger. And even those that still have reserves for dedicated schools, I find those reserves are dwindling and they're heading towards deficit. So actually, when you take all that together, the resources available to local authorities are dwindling significantly, and that not only has an impact on resilience, but also has the impact on the ability for making returns on treasury management or to internally borrow, so as to avoid those 5 to 6% external rates that are ramping up month after month. So there's quite a bit in there. It's not just usable reserves. There are other bits and pieces on the balance sheet that I think we've got to be aware of. But we'll move on and come to the capital side in a bit. So if we look at usable revenue reserves, I always put this together because it's a picture that frankly baffles the government. They don't really understand it. because they gave a whole load of COVID grants out over the last couple of years. Those COVID grants were held in reserve because of the timing differences with the collection fund. So what I have here is the bold line comes straight from the MERS. It's general fund balances plus earmarked reserves, take out the school reserves and DSG deficits, and doesn't include HRA. They went up significantly, but they didn't really. It went up in a far more modest manner, which is the dotted line, because I've removed from the bold line the business rate reliefs that were sat in reserves at the end of 2021 and 21-22. But what you're seeing then is some big reductions in reserves, and even when you take out the business rate reliefs, you're seeing reasonably significant reductions in reserves, which again hide massive differences between some authorities, and we'll go through that as we move on to the next slide. So this is without adjusting for the COVID grants, and you'll see there that every type of authority has seen quite a big reduction in reserves. Inner London's looks massive, but that's because Westminster had £300 million sat in COVID relief, sat in their reserves at the end of 22-23. So when you remove that, which the next slide does, this is the change in general fund reserves. The line's the average, and that shows each type. Now, Westminster, when you remove Westminster's 300 million, Inner London still have had a reduction in reserves, a real terms reduction in reserves. But actually what you're finding is that there's a split here between single tier and two tier authorities. Counties pretty much in aggregate are even on reserves, haven't really gone up, they haven't really gone down. Districts, they're still generally going up, although there's quite a few where they've come down. But single tier authorities, unitaries particularly, and a handful of unitaries even more particularly, have seen some massive reductions in reserves. I'd say unsustainably, and what I'm really tentative to say this, and I think there's something around the funding, the business rates gains that tend to favour districts that's starting to feed through into the balance sheet health, i.e. some types of authority that haven't done well out of funding are more likely now to be showing signs of stress through depleting reserves. Now, that's not an absolute conclusion, and it doesn't bear for all authorities, but there's definitely some signs that it's quite striking how shire areas, county and districts are still seeing reserves edge up slightly, whilst single tier authorities are seeing them come down quite significantly. If we move on one, so I'd say significant reductions, even when you remove the impact of the one-off COVID grants in 21-22, but actually it's not just general fund balances and earmarked reserves, it's all reserves. So schools balances come down, HRA balances are coming down, dedicated school grants deficits are going up. So taken together, big financial pressure on authorities, which reduces their resilience, but also has an impact upon capital financing, because internal borrowing is starting to show signs of reducing, and that exposes more authority to rising interest rates. And I can't, in the conclusion, there is a differential now between single and two tiers areas. Take of that what you will, but I think there's a little bit of the funding formulae or lack of changes to those that are starting to come through, and say, if nothing else, the need for a fair funding review is probably pretty important, and it will be for a handful of authorities where depletion is pretty significant. If we move on very quickly, I'll just run through the capital. So we're doing the balance sheet, we're doing a lot more work around capital health risks now. So we're looking at the need to borrow and how that changes, which is CFR, and whether the need to borrow is too high given rising interest rates or it's unsustainable. We look at the equity values, the capital adjustment account revaluation reserve, to see if assets are holding their value or they're depleting in value. And some authorities which now have negative CAAs because they've had such massive write-downs, particularly of investment properties. We look at debt gearing, that's a big part of what we look at, and we can show that the authorities that have gone 114 always seem to have debt gearing, high levels of debt gearing and increasing levels. But this year we're looking at debt financing costs. So we're scraping the MRP data from the accounts and also interest paid. Interestingly, the interest rates have increases have benefited local government so far, because Treasury management returns are much, much higher, about trebled. Interest receivables trebled over the year. Interest payable hasn't really changed, but that will start to as authorities move to external borrowing at rates that are much higher than they once were. So if we move on and very quickly go through the last few graphs, so the need to borrow is actually slowing down, whether that's because the government has become a lot more directive about whether you can borrow or not, and outlawing certain types of borrowing and making it less easy, or whether it's just general economic conditions. Need to borrow is coming down, but it's going up quite significantly now to London. And I looked at some of those authorities. They're doing some really big projects around housing, around regeneration. They're doing those projects. They're absolutely right to do them, in my view, but they're doing them at a time when to get the borrowing is much more expensive, and at a time when their reserves are dwindling. So it puts them automatically under more financial stress for arguably doing the right thing, but nonetheless more stressful financially. Let's move on, Adrian. So debt gearing has largely unchanged, other than in out London, where it's continuing to rise. Mets, it's continuing to come down. Mets have a lot of historic debt that they're paying down and have been doing for a number of years. And the capital health of metropolitan authorities is getting seemingly a lot better. But I know of Mets authorities that now want to invest in housing and other things. So again, it's a more difficult climate in which to do that. But generally, valuations seem to be holding up on assets, and generally people making prudent MRP provisions, which means that the CFRs are coming down by that amount. Move on one. But current resources are dwindling. So what this looks at is the capital financing requirement in ratio with current resources, which are all the usable reserves, be they HRA, be they general fund or schools, but also taking account of the fact that dedicated school grants that might need to be financed, also taking them off if they're in deficit. And again, what you see here is ever so slightly, because the need to borrow isn't really moving up, the ratio isn't moving up, but as resources dwindle, this is one to watch. And again, unitaries that I think look like generally, and certainly some of them that are under more pressure, have a lot higher capital financing requirement ratio to the resources that they have available going forward to be able to accept much bigger increases in capital financing costs. And so unitaries, I'd say, the most exposed type of authority. I'm moving on, I think this is my second to last slide. So internal borrowing is definitely slowing down. So this has ramped up over the last few years as COVID monies have been in the system, but now internal borrowing is starting to reduce, and in some areas, again in unitaries, it's starting to reduce. So that means that those areas are starting to externally borrow and are therefore exposed to the rates as they are now. I put an example there in Thurrock, who repaid a 350 million loan, which was at less than 1%, and took out a loan 700 million, so twice as much, at 5 times the interest rate. So their interest paid will go through the roof as and when, if they ever release accounts in the near future, which I'm not sure they will because of the issues that they have. So final conclusion on capital is the last slide. If you move on, Adrian. So need to borrow slowing down, except in outer London. Could be due to economic conditions, could due to the government's enforcement around this area. Debt gearing stable, but is high and rising at some authorities. And because of the interest rate rises and because of dwindling resources that we can see from our balance sheet analysis, some authorities are going to be more exposed to those higher debt costs, given that they're running out of resources, which will put an extra pressure on already stretched budgets. And we're starting to see that as internal borrowing is starting to reduce and external borrowing as a relatively is increasing. So again, more pressure onto already pressurised budgets. And that's the update for now. Thanks very much. Back to you, Adrian.
Cheers, Dan. Thanks for that. Final few slides now, just finishing off with looking at extended producer responsibility, EPR. We issued a briefing note, I think it was last week, about it. I know some questions were asked at our last webinar, and I didn't know much about it. So I've done a bit of research since, spoken to the LGA, spoken to quite a few authorities. I went to a webinar where the official at DEFRA was speaking about the whole policy and what it looked like. It was a bit worrying because I didn't really get the impression that Whitehall really understands the financial impact on local government, haven't really worked it through, think local government's in the loop, and they're not. We're not. We just need to know what's going to happen. But essentially, what EPR is it's new legislation that requires retailers and packaging companies to pay for the full cost of disposing of and recycling their packaging. I understand they only pay for about 10% effectively at the moment, and local government's paying for the rest. So this new responsibility starts in October 24. Whitehall thinks that the income from these retailers and companies will be about £780 million part year effect in 24-25, rising to about £1 billion a year for the full year effect from the year after. So apparently Michael Gove negotiated that all the income from this new responsibility that's been paid by these companies would stay within local government, but we don't know how that will be distributed. So in theory, the scheme administrator would pay the income over to each local authority. What it says here is local authorities can expect to receive additional income from the scheme whilst being asked to submit data relevant to their waste collection services. So some income is going to come over. In the policy statement, DLUC said that they would assess the impact of that income on your relative needs and resources, with the implication there that they would adjust the settlement in some way to offset fully or partly the effect of that additional income. We just don't know yet, though, what's going to happen, and we don't even know what those numbers look like. I think some indicative numbers for each authority might be advised this summer. June, July, August was kind of given as a time, but speaking to some of you, what you've been told is that you won't have confirmed numbers until early 2024 or even October 24. So this all feels very, very late. I picked up a few kind of flow charts from that presentation that I saw, just to get some idea of what is going on. One is that the payments you'll receive from the scheme administrator, which is effectively the income that you're going to get for indirectly from the waste and packaging companies, those payments will be based on a formula. There'll be an assessment of what an efficient operation looks like. I don't know how that's defined, and what happens if your operation is deemed to be less efficient and more expensive. I don't know. Various other adjustments will be made to those payments for things like rurality, deprivation. I assume things like area cost as well. And I think as well there'll be some allowance in there for some of the costs that you might incur. I guess they may be things like PFI contracts or new vehicles that you have to procure. I just don't know. And speaking to some authorities, even their waste managers are saying, well, we don't know what those costs would be. We're not quite sure what they are. So it feels very uncertain. And then the bottom chart is just showing you the kind of timelines that DEFRA are looking at. So as you can see, some kind of basic information in the summer, July, August, January, an estimated payment schedule, and then the actual determination of what the payment will be in October 24. What's the impact of all that? Well, in theory, there's all this additional income, £780 million next year. The decision in terms of the spending review is that all that income should flow in its entirety to local government, but that doesn't necessarily mean that individual authorities get to benefit from that income. It might be that the income is held centrally and used to fund something different. The policy statement talked about the position of the lower tier must be understood in the round, but as I understand it, the payments will come to any authority that's got a waste collection or waste disposal responsibilities. That's districts as well as counties. So it's not just the lower tier that's affected. It's right the way across local government. I mean, the policy statements seem to give a strong suggestion that would be adjustments, some kind of top slice maybe to authority settlement allocations, but that opens up a whole can of worms of lots of other implications on things like negative RSG or other grant allocations or the 3% funding guarantee. That's a really tricky operation to perform. and becomes very, very difficult if they haven't started to consult at this point. And lots of potential risk and uncertainty about the amounts and therefore about the adjustments. This is important for all authorities, but it's particularly important for smaller district councils where this income could be a really large proportion of your core spending power. And in terms of timing, we just don't know. We've been given no indication about when or whether there will be a consultation, or even whether these changes are going to be made in 24-25. At least one authority's contacted me to say they've been told by DLUHC that there won't be any adjustments in 24-25, and that authorities will be allowed to keep the income. Now, I just don't know whether that's still their current thinking or whether they'll follow through on that. There are lots of different potential scenarios, and in reality, I've got a lot more questions than answers, to be honest with you, in terms of whether they do change the settlement, whether authorities do get to keep all the income that's coming through, and how they will do that. Has DLUHC thought about what the knock-on effects will be? Things like negative RSG, 3% funding guarantee. Are there any additional costs for authorities? I don't know what they are. So lots and lots of issues to think about there. What do you assume in your MTFP and your budget plans for next year? My view is that without the clarity about how this works and without having consulted on any process yet, I think it's getting quite late to make any changes in the settlement in 2024-25. So the big question is whether the government allows local authorities to receive what amounts to a fairly large windfall in 24-25 without any adjustments. So it's worth about 1.2% of core spending power, or whether it does something different. A few potential scenarios here, whether it makes no adjustments to local authority settlement and just holds it all back centrally for things like funding, waste programs or funding other grant increases. So no specific income gains there for local authorities, or whether it makes no adjustments in year one and allows authorities to have some income gains from that flowing through of that £780 million, with some of it top sliced for sector-wide funding initiatives, or whether the whole thing is just cancelled or delayed because lots of retailers are really pushing back on this. So for now, I just don't know what that means. I would assume it's all neutral for now because there's just not enough information to go on, but it's one to really keep an eye on. Apologies for overrunning. I've gone over by 5 minutes. As I said, we've done a recording of today's session, so if you do feel the need to have a look at it again or to pass it on to colleagues, that should be there. And we're going to go over to have some chat and debate and questions and answers. If you can't stay on for that later session, thanks for coming along today and joining us. It's been really useful, and really thanks for getting involved in the polls as well. That's been really helpful. Some really good data there. So thanks very much for all that. Dan, I can see you're excited because you've got 2 more sets of accounts to have a look at.
Yeah, I've just downloaded Teamridges. Thanks, Martin. Looking good.
That's good. That's great. Nick Morgan, I see you said I suspect the EPR local government element will push back next year. I kind of think you're right there, to be honest. I kind of think you're right. It's such a lot of money. It's so late, it's so complicated. I just don't think DEFRA are on it at all. They think DLUHC are handling it all really well. But I don't think that, from what most of you said, I don't think authorities aren't in the loop on this yet. And then Anna, good point there. I think the EPR income will change over time. Yeah, the idea is that it makes businesses do things differently. So it's not going to be a permanent income at that level. You'd imagine it would. The idea is that it stops businesses using as much packaging, I guess. Yeah. But it's been I think EPR. I think it's too tricky for the government to handle at this point. I suspect they will be. I suspect they'll either cancel it, postpone it, or just keep the money centrally and redistribute for costs rather than redistribute it as a windfall.
A couple of people asked about the DEFRA monies on food waste rollout. Adrian, have you heard anything more about that? I think it's mainly capital monies, but that was at the end of the spending review period, wasn't it? For the last but one spending review.
I've not seen anything about that. I've not seen anything at all. I don't know whether that's in the same sort of work stream as the EPR stuff, and I think it's the deposit recovery scheme and all that kind of thing. It feels like a lot's going on, but I don't know what they are on that specific thing. Yeah.
Tina's asked if I think we'll get 3% funding guarantee again.
I think you will. I'm pretty sure of that. I think, Tina, I think what that policy statement saying that the core settlement will remain the same, I think that means that those features in principle are going to continue for a second year. 3% funding guarantee being part of that. I mean, maybe they'll change the figures and some of the thresholds, but I think the principle remains the same, and I wouldn't model it any differently from how it works in the current year. To be honest, I think the clear implication is that this will stay the same. The issue might be whether there is a change in Young's bonus, but I suppose the 3% funding guarantee is designed to cope with that. If there's more EPR income coming through, is that inside or outside the 3% guarantee? I don't know. I don't know at all.
I think they've shown previous one. I think if the EPR income comes in, then they'll say there's a funding guarantee at 3%. You won't need it because the EPR income will do that for you.
Yeah.
And the EPR income last year, the funding guarantee last year had a one-to-one relationship with the reduction in UM's bonus and lower tier services grant. So it's just a shield to remove those areas of funding. To me, I think UM's bonus is so small now, it's almost not worth fighting about. But now it's down to a year. But that's where I fear they'll use it as a transition to get rid of the streams they don't want, and just to make sure no one loses out for that before it disappears behind new income. So I'd really fear for districts on that, because I don't think the EPR is extra money and everyone's pegging their hopes on that. But I think that will be used to then take funding guarantee out of the system, because EPR will be the funding guarantee.
Yeah. Yeah, there's quite a few. I said, Dan, there's quite a few questions about the garden waste income, food waste funding, things I've not looked at that much actually. So maybe that's something to have a look at, to be honest. Just looking through some of the other questions. Alan's asked a question about if the business rate multiplier is high due to CPI, would that result in lower 3% funding guarantee grant for 24-25? I think in principle, I don't think it would. You're either going to get the funding as cap compensation funding or as an SFA increase. It should come through one or the other. I mean, as I said, there's a slight difference for some authorities where you would get more from cap compensation if the multiplier is frozen than you would if it goes up in line with CPI. But both those things will be taken into account in the funding guarantee, and I'd imagine they shouldn't be that much different for most people. Yeah. And then Stephanie, you assumed 7.4% for CPI for inflationary costs, but a couple of percent lower for business rate multiplier. That makes sense. So you're kind of down at about 5.5% for the BR multiplier increase. Yeah. Were you shocked by any of the poll results, Dan?
No, I got the first one wrong. I went for more than 7%, and most people were less than 5%.
Yeah.
I should read my inflation figures better. No, it was good fun though, a poll, isn't it? I must do more polls.
It is. I'm pleased they worked. I must admit that was. I suppose I shouldn't have been, but I suppose I was surprised that people had gone for a CPI that's so low. But better to be prudent than to be too bullish. I mean, I think we try and kind of guess what we think that the answer will be, but if you're putting together a financial plan, you want to be prudent rather than over the top.
Coral's talked about persistent organic pollutant. What's a persistent organic pollutant, Coral? Loss of income on inert waste. Yeah, and that I think share that sentiment, Alan, about, because I remember when I was 151 when that first came out, and the authority wanting to get on with its food waste rollout, and so we can't in good conscience let the taxpayer pay for a whole load of vehicles if DEFRA are going to pay for it in a year's time. But
yeah,
they have gone very quiet on that. I don't know. Does anybody know of anything coming out from that supposedly cost neutral rollout of food waste? Anyone got any insight on whether that's ever going to materialise? Because it was costed up in the spending review, Adrian, wasn't it? It was quite a bit in DEFRA, but I know it was in the last year.
Yeah, I wonder, Dan, whether DEFRA has got so consumed by dealing with you know, their big new policy stuff, the EPR stuff, the deposit recovery scheme. I've had a look at some recently, that sort of stuff. They seem really big things, and I just wonder whether all their bandwidth has gone on that, and actually some of the other stuff that they, you know, has had less, less work
possibly,
on it, or
possibly,
not sure. But yeah, on those responses, I think it's something we'll have a look at, because it's obviously an issue. So we'll have a look at that.
We'll have to put Paul on that next time, Tina.
Garden waste. Yeah. I think Ashley had a few questions I noticed dotted around the chat. I think the first one actually was about that was about food waste. The next one down was about the movement, how the calculation works for the cap compensation fraction. Yeah, you can track that and check it in the model in the inflation and indexation tab, on the yellow tabs in there. It shows you how we've calculated the new fraction, and you can change, and as you change the assumption for CPI, that will change the fraction as well. So you can check that. You can check how that works. I think Jonathan, in the comment straight after that, clarifying how cap compensation works if the multiplier does increase. Yeah, so again, if you look at that tab on indexation and the multiplier, that'll show you what would happen if what would happen to the fraction if the multiplier is frozen, and what happens if it's not frozen. And you can, as long as you flick the right select the right options in the model, you can see both those two scenarios of, frozen, not frozen, and then what that looks like with different CPI assumptions. So if you want to go through that in more detail, just let me know. And then the second part of that question, Jonathan, if the multiplier is not frozen in 24-25 or future years, you would continue to get that cap compensation funding at the same level with the same fraction in future years, I think, right up until the point where there's a baseline reset, at which point you don't need that funding, because everyone's at baseline, you get funded at baseline. But I do assume that all that funding, that 3 billion quid's worth of funding, or whatever it's going to be, would get recycled within the sector. So you wouldn't lose it from core spending power, but it might be recycled in a different way. But if you want to go into that in more detail, just let me know, and we can have a more of a chat about that. I think Ashley had a couple more questions as well. Just scrolling through. Yeah, in the model, we do assume that transitional relief is constant. That's right. And but as you say, it will reduce over a year as people come out of TR. And the same with the RHL relief. The reason we keep them constant is just because we don't know how quickly they're going to reduce, but both those two things should be neutral on the bottom line. With transitional relief, as it goes down within net rates payable, it gets added back into non-domestic rating income, so it's an in and out factor. And that's similar with the RHL relief as well, that if the relief itself starts to reduce, you just get less Section 31 grant for it. So it should be neutral on the bottom line. Was that it on?
Karen's asking does the model include revaluation tariff adjustment? It was mentioned last year's statement.
Yeah, it does. So just saying that we've got it's got there's hard coded numbers for the initial revaluation adjustment in 23-24, and then we've got an updated version of the model that will help you calculate what the revised or the final ongoing adjustment is for 24-25, and what the one-off adjustment is as well. So that's now plugged in there. So if you put in your new NNDR outturns for 22-23, that should calculate your new revaluation adjustment. But there are, as I said, there are some. It's a really complicated calculation. It did take me a long time to replicate it, and there are some quite tricky wrinkles in there for authorities with designated areas, that kind of thing. So if you're worried about it, just let me know and we can try and work through it.
Anybody else willing to? Anyone else going to get their accounts out today? Anyone else direct me towards websites where I might pick up accounts? Or have most of you published just now? Or are most of you still waiting for the auditors to sign off 21-22 accounts? Oh, excellent. MKCC, is that Milton? No, Milton Keynes. 22-23 would be nice, Tina, but if you've got earlier ones, I'm always willing to take those.
Yeah.
No, it can't be Milton Keynes, can it? What's MKCC, Vicky? I guess I don't know what people. Oh yeah,
City Council.
City Council. Yeah.
Oh,
okay, I'll look up for Milton Keynes.
Thanks. Good.
Are people concerned? One thing that we think we might look at now is RA. I don't like to look at RAs, ROs, but it's clear that there was designated use of reserves last year, but also unplanned use because of the inflation and that. But it'd be interesting to get people's view as to whether things are calming down in 23-24, or that you're expecting similar levels of depletion of reserves, or whether you're turning the corner on that. So it'd be interesting to know what people's views are on that, in terms of where you sit now with budgets and likely pay increases and continued inflation. I know the energy prices are starting. Well, energy prices coming down for homes, aren't they? But I don't know to what degree they are for local authorities and businesses.
I thought your chart, Dan, where you showed that single tier authorities have got biggish reductions in usable reserves, but in two-tier areas, both counties and districts are both much more stable.
Yeah,
that's a very strange split. I can't quite work out what that is.
Yeah, and that's where I'm a bit tentative in that. There's still districts that are piling quite significant business rates gains into reserves, and that's what you would do. Yeah. So I think that explains the districts to a degree. Counties, I wonder, because they generally counties were always the least well funded on spending power. But over the last 13-14 years, they have higher reliance on tax base. They tend to have bigger tax bases. The 5% increases have therefore benefit them. They had less to lose in funding and more to gain from increases in council tax. So I wonder if they're a bit more. They've got a bit more resilience in their tax base than authorities that were high needs and low tax base, where they haven't recovered anything through council tax, but they have lost a lot of funding. You've got to be really careful that. I know Jason at Somerset told me that some of Somerset's reserves are reserves that they hold for the health service, so that there's lots of things in reserves that can be explained away. But I think what was interesting for me looking at the balance sheet is that HRA and school reserves are coming down, that the school DSG deficits are going up, and they all pull from the available resources, which points to resilience, but also ability to borrow internally and or get good returns from the interest rate rises. So it's all really interesting.
Yeah.
Nick's,
Yeah. Nick saying, looking at significant reductions on energy costs against original assumptions. Yeah, that's interesting. The point Martin makes there, particularly one at the end, lack of more investment income to offset, but for how long? You do wonder whether, I suppose, energy price is less of a pressure, but at some point those investment income returns, they're going to start switching as people have to get, incur more debt costs.
Yeah, I do wonder with that, as there's less resources to invest. And the interesting one this year is the pay award, isn't it? Because if inflation doesn't come down soon, presume there's, I don't know what people are putting in, but the pay request from Unison will be presumed it's quite a bit bigger this year. I'll have to ask my wife. She's a local government employee. But what are people putting as pay award? What are people anticipating? Is it 5-6%, or is it another one where a minimum increase plus a percentage so that people on lower bands get paid more? Any views on pay award?
If I thought I could write it fast enough, then I'd write a poll. But
Yeah.
Started off as started off as CPI plus 2%, didn't? Yeah. I mean, in one of my charts, we've got the GDP deflator, which looks like it's kind of going down and almost going negative. Not negative, but it's going down to sort of almost to zero. I just wonder whether that's a bit too optimistic, and actually, GDP deflator kind of tracks what pay awards look like. I just wonder. Well, so pay awards is one of the big factors in determining what the GDP deflator looks like. I just wonder whether, those pay awards are going to start to be a bit more sticky, a bit higher than people are expecting over the longer term.
But the government's starting to get a bit. It's saying that it might disregard independent pay review bodies because it doesn't want, because they're all coming back 5-6%, isn't it?
Yeah.
So,
yeah. Apparently, we could all earn more in Australia. Thanks, Anna, for the link. So we'll have a look at that as well. Maybe come back and do a bit more work on that, I think, possibly. Yeah.
RPI plus 2.
Yeah.
So that'll be 9%. What's RPI? Still at 8 something, isn't it? Or was that CPI?
8 point. Was that RPI? Is it RPI or CPI?
RPI plus 2 is the NGC pay claim award.
Yeah. Yeah, I'm not sure what RPI is. It's probably above 9%, I'd imagine. So that's a whopping increase. Yeah.
Well, yeah, plus about a 7% reduction in working hours, so that'll be even bigger. 35-hour week. Gosh.
Yeah.
But I guess that's the starting point, isn't it?
Yeah. So Dan, do you include the GLA accounts in your analysis? Martin saying they're due delayed till next Friday.
No, I don't have a place for GLA because they're their own thing. I do have a look at them. So it would be interesting. And the City of London as well, which last time I looked had so many reserves. It was unbelievable. And Silly as well. I picked them off, but don't include them in any of the benchmarks because it's no real similar authority.
Yeah, too much of an outlier. Yeah. Okay, Dan, I think that might be us for today, I think. Unless anyone's got anything else they want to say, or any more questions or comments. So it's been quite a full session today. I'll get the slides on the website as soon as possible, and I will also make sure that the polls are in there as well, so you can see what those numbers look like. I think I'll probably put them in the slides themselves, so they're all in one place together, and I'll try and get that out as soon as I can. The recording, as I say, will be there by Monday. But yeah, thanks very much for coming along. Thanks for contributing. Thanks for your questions and your comments. It's actually been really good. Thanks for your presentation, Dan.
Yeah.
That was great. Really interesting. Thank you. Yeah. Oh no. I saw Kirsty Nussum put a hand up very briefly, but straight down again. So thanks very much, everybody, and have a great weekend. And we'll see you soon. Thank you.
Thanks, guys. Have a good weekend.
Thanks.
Bye.
Bye-bye.
Thank you. Bye.